So I am seeing that the decrease in rate is allowing people to take a second look at things, and they're getting in, which is going to keep that demand high. Even with interest rates coming down, it does not solve an inventory problem. So being prepared and knowing what you can do with contingencies, utilizing some great programs to make your offer stand out, it's going to be key.
Let's dive into that quickly, because I know you guys had this program before. Let's talk about the whole, when we're coming into a potentially a strong market again. Appraisals. Tell me about what you guys have, because we know we've had some clients leverage that. Great program. So tell me a little bit more about that so we can get prepared for this spring market.
From a listing agent standpoint, they want the cleanest possible offer for their seller, because they have to make recommendations to their seller based on data in those contracts and the lender information. We give the client 3 options when they're going through the process. We can give them a pre-approval letter. We have our approved to move. The financing contingency is one that shows how strong the borrower is. If the borrower will allow us to, we can do a full underwrite for them before they even pick out a property. We kind of set the parameters of how far or how much they might be going up to, and then based on their income and their assets, our underwriter, who the only person that can give an approval on a loan is an underwriter. The underwriter will analyze those documents, income, assets, based on the loan program they're doing. They can issue a TBD loan commitment. So now, it doesn't guarantee that the borrower is going to go out and maybe do something to adversely affect their credit, but from a standpoint, we have validated that on a person buying a $900,000 house, putting 20% down or 10% or 5%, they are approved as long as they don't do anything to adversely affect their credit or their income. The last part, which is proprietary to Embrace Home Loans. If by chance the borrower is only putting down 5% or 10%, before they even put an offer on the property, all I need is an address, an NMLS number, and then I have to know that the borrower has been either through underwriting or I've sent a loan package to them. We can evaluate or pre-evaluate and issue or potentially issue a value certificate for that property. For example, the likelihood that Fannie Mae or Freddie Mac will come back with a property inspection waiver on a 5% or a 10% down is slim to none. But what Embrace wants to do is put our arm around the borrower and say, look, we know you have limited capital. We have done our independent research on the property, and we will stand behind you on this, and we will issue a value cert to X if it comes back in the system. You and I have done it a few times where you were able to go in, waive the financing, waive the appraisal, and we were able to give the borrower comfort and to protect their capital, knowing that we could go up to X price on an escalation and it not cost them a dime. Between your information, our information, the borrower was able to win the deal. And we did have to get an appraisal on the property, and when the appraisal came back, it came back even above what we thought, but the borrower was already in a position where they were protected, their capital was protected, they weren't going to have to bring a dime more to the table. We closed the loan, I think, in record time because we already had their file done, subject to title and an updated pay stub and maybe a bank statement, and we were done. Oh, and insurance. They had to get insurance on the property. And we're not just doing a mortgage analyst. We're not just analyzing their mortgage. We're actually doing a financial consultation between your evaluation of the home, showing how we're going to move, assets from one bucket and we're going to put it into another. And because it is risk. I mean, when you're buying a property, even though we've been enjoying great appreciation, we're helping them diversify their portfolio. You're putting some of their capital into equity in a home. We want to encompass all types of their portfolio and make sure that we're analyzing their cash flow. Maybe their kids are in private school and we have to account for that even though it's not on their credit report. It's more of an encompassing review that we do. It's not just click here, get mortgage. I mean, we've got great technology, as I know you know, but it's that personal touch that we want to add to the process, because I know how great a job you do with your team. We want to mirror that on the finance side so that they feel like they're getting a true team approach to making sure they're making a good decision.
100%.